welcome back to Cashflow Confidence. I'm Shelby Ashley, and I help business owners feel more confident about their cash flow. So continuing our discussion on marrying up revenue with what's actually in your bank account. The last few episodes, we went through revenue, we went through cost of goods sold and your gross margin. We talked about overhead, marketing, payroll. We covered everything that you're going to see on your profit and loss to help you arrive at your net profit. And now we're going to take that net profit and I'm going to lead you through how to tie that up with what's actually in your bank account. And so in this episode, I'm going to be talking to you about your accounts receivable balance and your accounts payable balance. Or said differently, it's money that people like your customers owe you and the money that you owe your suppliers. I know this doesn't sound super exciting, but bear with me because these two areas can really make or break your cash flow, even if your profit looks really, really good on paper. And so if you've ever said to yourself, well, I know I made money, but I can't even pay myself yet. How did this happen? I had all this work that got invoiced out and I don't even have money to pay myself or pay my expenses. Or my clients are just paying super late and it's really messing everything up. I always feel like I have to rob Peter just to pay Paul. Then stay with me. I'm going to be breaking down what your accounts receivable and your accounts payable really are in plain English, not talking to you like an accountant, how they really get a grip on your profits and how they can choke your business if you're not careful. And then I'm going to talk about what you can do this week in order to get a better handle on it if you feel like it's kind of getting out of hand. So like I said, your accounts receivable is the money that you have earned, but you've not been paid for it yet. So you've sent all your invoices out to all your customers, but they haven't paid yet. Then that means those invoices are sitting in accounts receivable because you are still waiting on them to pay you. You're still waiting to receive payment. On the contrary, your accounts payable balance is the money that you owe somebody else. So maybe you've got a contractor invoice that's sitting in your inbox or, one of your big suppliers like Home Depot or Grainger or whatever. If they gave you net 30 terms, then that's going to go to accounts payable and it means, hey, this is due in a certain time frame from now. So the thing is, your profit and loss doesn't really care about timing because it can show that you made $10,000 worth of profit for the month. But if all of that $10,000 is sitting in accounts receivable and you haven't even collected it yet, then what was the point, right? So you really need to take care of this because let's say you're waiting on your clients and your customers to pay you, but then you don't have good terms with your suppliers, everything's due tomorrow. That's not a really good spot to be in at all. A great spot to be in is when your clients pay you either due on sale or they pay you within the next 15 days, whatever it is. But then on the accounts payable side, you don't owe anything for the next 30 days. That is a great spot to be in. That's called having free cash flow. So this is why so many business owners can be so profitable but feel so broke and so stressed out when they're trying to pay things because profit does not equal cash, right? So let's talk about accounts receivable for a minute because that is the number one cash flow killer that I see with all kinds of businesses. They do the work, they send out the invoice, and then it just falls by the wayside. They don't get paid for it. Meanwhile, you still got to make payroll, you still got to pay for your software, you still got to pay rent, insurance, and then your own salary gets put on pause yet again. And so what I recommend doing is logging into whatever accounting software you use, even if all you use right now is an Excel spreadsheet. Pull your AR aging report. That's going to show you who owes you money and how late they are. And you're going to be surprised at how much is probably sitting out there. I've had business owners I've talked to that have found invoices that weren't paid 8 months prior. And we're just now having to call these people hey, just saw where you didn't pay me. It's not a great look, right? So if you see anything that's getting close to 30 plus days late, start calling these people. You are not your client's bank. You are not going to mess up relationships with your clients and customers by asking them to pay you. And then if you see that it's kind of growing in that 30 to 60 range, maybe consider changing your payment terms to due on receipt or due in 7 days instead of due in 30 days. I had a client that we ended up changing her payment terms for this reason because people weren't paying on time. She switched her payment terms to due on sale, and that was able to bring in $60,000 more for her that year on money that she had already recognized the profit side of. So this is just tax-free money because she just changed her payment terms. So tighten up on your payment terms and look into automated reminders. A lot of invoicing systems have reminders that they'll automatically send out to anybody that's late. Take advantage of that. That way it keeps you from having to, make that awkward phone call or find time to send those email. But the point is, you worked for that money. Don't let it sit. Follow up on it. Now, on the flip side of this is accounts payable. So a lot of business owners will try to adopt the mindset of, I just want to stay on top of everything, and they'll pay everything the second it hits their inbox, which is great if your cash flow can support it. But if you're paying bills early, but you're not collecting on your invoices very early, then you're putting yourself in an unnecessary cash flow crunch for no reason. And so to get a hold of your accounts payable balance, what I want you to do is make sure you negotiate good terms with all of your suppliers. If anybody offers net 30 terms, do what you have to do in order to take advantage of those terms. And so if you want to look at this in a more strategic manner, pull up your upcoming bills or your vendor due dates and look at your cash influx schedule. And then ask yourself, can I delay any of these payments without being penalized? And so that's kind of how you manage your cash flow, because you don't want to put yourself in a position where you're paying all of your suppliers earlier than necessary, so just getting rid of your cash for no reason. Meanwhile, you're waiting on all your customers to still pay you, right? So if a vendor is offering net 30 terms, take advantage of it. Take advantage of the full net 30 days that they're giving you. If you have a credit card that has a 0% APR period, use it smartly. And by smartly, I mean use it for things that you know that you are going to be able to pay back. And so if you are beginning to roll out a new offer, or you're a new business owner and there are things that you have to buy in order to get going, take advantage of that. It's usually a 6-month or maybe even a 12-month period where your credit card's going to be 0% interest. And then once you've got things set up and in place, you can start earning money and then paying that credit card down so that you're not having to pay any interest. And so if you can align your outgoing payments with your incoming receivables, that's how you buy yourself time and, a lot of breathing room as far as your cash goes. So the reason why these two items and a few more that we're going to talk about in the coming weeks get so overlooked is because chances are your accountant is probably not watching this for you, because your accountant and your bookkeeper just record what happened in the past. They're not really looking ahead to help you time your cash flow. And that's kind of where CFO strategy comes in, because CFO strategy really, really centers around future cash flows, and accounts receivable and accounts payable are a huge, huge component of that. Like I've said before, you can have all the profitability in the world, but your profits are just a number on a piece of paper. They do not pay the bills. Your profits do not pay your employees. Your profits do not buy new equipment, and your profits definitely don't help you sleep at night if you're not collecting on any of it. So if you feel like your sales are doing great, you're keeping your expenses in check, but something still feels not right, then it's probably a timing problem between your accounts receivable and your accounts payable, and it's totally fixable. You just need to start watching what is coming in and what is going out and when. And like I said, you have got to start pulling regular accounts receivable reports and seeing who still owes you money and following up with these people. And then on the flip side of that, review all of your suppliers and people that you pay the most and see if you can take advantage of any terms that they might offer. But your accounts receivable and your accounts payable are not the only areas where your profits can get tied up. So in the coming weeks, I'm going to tell you guys about a few more areas where your cash might be stuck. But in the meantime, I'll see you guys next week.